Reality radio for a really great future. We're talking real money.
You know, they say time flies when you're having fun, but I think they really mean time flies when you're getting old. Because it seems like less than a year ago that it was a year ago, and now it's a new year. It's already 2026. Holy mackerel. And yet, the good news is I'm still here taking your questions. Better news is you still keep sending them in at talkingrealmoney.com on the contact form. Thank you so much for doing that. And you can keep doing that because we're going to take questions for as long as we are able. You just go to talkingrealmoney.com, click on the Contact Us button, which is in the upper right corner right there. And then if you want it on the Friday podcast, you need to record it. The Friday podcast is the recorded, spoken questions. The ones that you type in get all over the place. So record them. Ask them. Ask away. And I will try to answer to the best of my ability. And let's get this new year, new show, new Q&A thing underway with this question.
I am anti-annuities for the most part. I've been learning about QLACs, Qualified Longevity Annuity Contract. And they sound kind of interesting. So just wanted to know your take on QLACs. Thank you, and have a great day.
Well, QLACs. I hate annuities. They're gonna win. They know the math. They're going to win. They win. It's so the odds are so stacked in the insurance company's favor. Most QLACs don't start paying out until you're really old, like let's say 85. Okay, so let's say hypothetically you put $200,000 into a QLAC at 85 or in your 70s. It doesn't make you any money. They just promise you a guaranteed income starting at 85. And I did some looking around, and it looks like on a $200,000 QLAC, they would be paying you about $25,000 a year in income. Well, it's going to take you till age 93 just to break even, not counting any interest you might have earned along the way. I mean, you got to get into your late 90s for it to start to make sense. Do you know how few people last until their late 90s? It's just like it's a tiny fraction of 1%. It's so small. The insurance company knows they're going to win this game. They're not going to have to pay out anything, really, for most people. And if they have to pay out, they're not going to lose money. I can't even imagine a scenario in which they have to pay out more than they made on the money. I mean, it's just a ridiculous premise. The insurance company loves coming out with catchy new things, and they try to appeal to our fear. We fear running out of money in old age. We really do. But, you're not Dick Van Dyke. Most people who live into their 90s are not living a very expensive lifestyle except for the medical care part. And if it gets that bad and you run out of money, well, there is Medicaid. It's not a great option, but it's better than nothing, I guess. So no, not going to be a good big QLAC fan. I really am not. The insurance industry just annoys me. Let's go to the next question, shall we?
I actually submitted a question relating to a Medicaid contract annuity that my sister was talking to me about over lunch a couple days ago. And she actually had an additional question that I told her I would dig into a little bit. And this actually relates to an Allianz 222 annuity that her and her husband purchased 10 years ago. Now, she is 60 years old. Her husband is 62. And with this annuity, they paid $100,000 for it. And apparently after 10 years, they get a $20,000 bonus. And you can start collecting on this when either spouse turns 65. And then you can start collecting a monthly benefit. I think she said currently it's worth about $112,000, which not good, right? And my question is, and her question really is, I guess, 10 years ago, she wasn't as educated as she is today. And she realizes this is probably wasn't a good move, but it is what it is at this point. Wanted to get your input on this. I think, when they start collecting, based on a little research I did, through AI, they would get somewhere in the neighborhood of $600 to $800 a month. And there's a long-term care rider attached to it too. And based on what I could find out on that is I think for a X period of time, you collect double your premium, whether that's 1 year, 2 years, 3 years, or whatever. I'm not really sure. So really the question is, I wanted to get your input on this. At this point, do they just, let it ride, start collecting the premium at 65? Or would there be an argument to potentially cash out on this annuity and then just invest that money? I'd be interested to hear your thoughts on this. Again, love the podcast. Can't wait to hear your reply on both that Medicaid contract annuity and now this question on the Allianz 222 annuity. Thanks again. And I will pass on whatever info I get from you guys to my sister and her husband. Thanks again.
As you and she have already realized, this was a terrible investment. In hindsight, it was just awful. But we've been not recommending these kinds of products for a very long time. So at least we've been on the right side of the advice. These are made to be sold, not made to be purchased. They're not generally good. They solve some minor problems, but this is actually pretty sad. And that's because there's too much stuff going on. They're cramming too many things into this policy to make it magical. I mean, they're looking at a tiny income, really, from this. I guess it's okay, but bear in mind you're getting your principal back. So I guess that's the upside. There's a guaranteed income. That's kind of good. The long-term care rider is usually pretty pathetic, and it's usually capped at a very short period of time. They're not going to get big checks. They're going to get, like maybe 2 or 3, 4,000 a month. Maybe best. No, like 3 or 4, like 3,000 a month. But the fact of the matter is now it's kind of as you know, the reality is if they get out of it, they're not going to get that 20,000. That 20,000 is magic money. It only goes toward increasing their benefit. So they get a benefit on 120 or 130 instead of on 110 or 112. But if they wanted out of it, the best they would get would be the 112. Which means they've got 10 years of guaranteed negative returns after inflation. It's hard to swallow. I'd be I don't know what to do. I truly don't. At this point, because it's already done. So you either accept that you've got this annuity, this pension of a few $100s a month, and the possibility of a little help with long-term care, or you kind of just start over at square one. You say, well, that was a mistake, and I'll invest it and see how I do. But investing it takes time to rebuild it, and I don't know how much time they have. I mean, they're younger than me, so hopefully more than me. But this is a really tough call. Again, in hindsight, it looks bad. But if I was advising somebody from scratch, I would say run away from an annuity like this. This is proof that they fib about the returns because that $20,000 is not real money. I know that there is no way that if you wait a few months that they're going to give you $132,000 if you want to cash it out. They're just not going to do that. That's play money. Thanks for the question and the previous question. And let's go to the next question that came in from talkingrealmoney.com.
Hello, Don and Tom. What I'd like if you guys both could look into for me, because I really respect your guys' professional opinion. If you could look into Abundo Wealth. They're an advice-only advisory firm. My situation's pretty non-complex, and I feel for another 10, 15 years, this would be fine for me, to where maybe I get older and can't take care of my stuff. Maybe then I can move to a total hands-off type approach. But appreciate any input you guys have on that.
Well, I did a lot of research on Abundo Wealth. They have a great fee structure. They charge $700 up front and then $200 a month to be a part of their advice system, where you can go online and have a portal, a dashboard where you can manage your portfolio and do some other things, and you can ask questions of advisors and get some advice. But it's going to be really, really basic. You're going to get what you pay for, because they only do, from everything I've read, it looks like they just do a 3-fund portfolio: a U.S. index, an international index, and a bond fund. That's it. They'll send you blog notices and things as to when to make changes to that portfolio, but it's a 3-fund solution. The only other benefit is that you can get in touch with an advisor and get some help. So that may or may not be worth the $200 a month. I kind of think it's a really interesting way, as you said, for someone who needs a little advice and doesn't have a complex portfolio. But my guess is you could probably build a better portfolio on your own. So the $199 a month might be a great amount to get advice. But I would probably end up skipping their portfolio. I can tell you, if I was using them with even a fraction of the knowledge I have, I would probably build a better portfolio without them. I would not just strictly use indexes. Not that that's a bad thing, but the fee structure, it makes that's reasonable. Who knows where it's going to go, but for now, it's a pretty reasonable fee structure. It's a whole lot cheaper than a full-service advisor. But my guess is, and all the reviews and the like say, you're going to get less. You almost always get what you pay for, unless, of course, it's in non-disclosed commission businesses. And that's the issue. I'm a big fan of disclosed fees. If a stockbroker or a duly registered advisor or somebody like that wants to charge commissions, great, charge commissions. Just tell your clients up front, not hidden in the fine print, buried in the prospectus or the summaries, or not even disclosed at all. Tell them what you are making on this thing, and the fact that it's got to either come from the client or the company. And the company only can get it from the client, so it all has to come from the client. But no, Abundo's, they're fine. I don't see anything wrong with them except for that small portfolio. Thanks for your question. Let's get another one in.
Hi, Don and Tom. This is Bob from NorCal. Want your opinion on a situation. We currently have a fiduciary. We started that in 2024. Before that, I was a DIY guy, and I did have Vanguard personal advisor service for a few years. But I decided to go full blown with this because of my situation with my wife and kind of a hybrid situation I had with my 401k. Anyways, I had started talking to Merriman back before I did the Vanguard advisor service and decided not to do it, but I eventually decided to touch base with them again. And that's when I decided to go with them in 2024. They then recently merged with Focus Partners Wealth. And I recently was talking to my advisor. We have basically a 60-40 balanced portfolio. And as far as our bond allocation, I guess they are now, in our situation, they are recommending for us, instead of the 4-bond ETF that we currently have, which consists of VGIT, VMBS, VTIP, and BSV, obviously in percentages. They're kind of recommending now to go along with their, they call it their systematic fixed income solution because of their larger trading capability with focus or whatever. But basically, it would be a CD and Treasury ladder and some other possible securities. And they would actually take 90% of that bond portfolio, roll it into another IRA, and have it set up into that CD and ladder structure. I've got a lot of different questions here. That would incur no cost. Now, granted, 0.04% is very little cost on a lot of these funds. And, there's no conflict of interest according to them and all that. And, obviously I would have greater stability from a down market in the bond, but, I just trying to get a different opinion on this and getting some clarity on this. Anyways, I hope you can help me with this question, or I'd like to get your insight. Thanks.
Well, you really put me on the spot here, but I take everything. Okay. I used to work for Merriman. Tom really worked for Merriman. But here's my personal feeling about this. And by the way, I've had this discussion with my own firm and with some of these wholesalers who come out pitching some of these products like this systematic thing. I mean, I know BlackRock's doing something like it. Other companies are doing something like it. Everybody's looking for that little bit of an edge. We could do something fancier. We'll do something a little more complicated. It sounds more complicated to me anyway. Doesn't it to you? It sounds more complicated. Heck, to me, 4 fixed income funds sounds too complicated. But at least they're pretty straightforward. And you don't know what kind of costs are hidden in the back of this fund. You don't. I don't know that they even necessarily know. There's costs. There's got to be a profit for whomever's running this thing. Just all of this smacks of gimmickry. And here's the thing. You sent in another question right after this one, and I'm going to add that one in right here because this saga continues.
When I was talking to the guy about the fixed income situation, they also brought up another situation. We have a REIT that makes up a 5% sleeve of the portfolio, besides the bond and equity exposure. And they were talking how it's really not kind of like given enough diversification, from their analysis, blah, blah, blah. Anyways, it's the American Century Avantis real estate. It's a global real estate ETF. So they basically brought up, in order to get that, they're talking about a 5% sleeve, being in some kind of alternative. Well, originally they brought up, what they brought up to me was something called Cliffwater Corporate Lending, CCLFX, and then Cliffwater Enhanced Lending Fund, Class 1, CELFX. Now, these have got high expense ratios, and they are, it's a private debt lending thing, whatever. Yeah. Anytime I hear private, it's not private equities, but anytime I hear private and some lack of liquidity, I get a little bit freaked out. Anyways, after doing some more discussions, they also offered me, well, if you want to get an alternative, because we're gonna do something as far as all, getting more diversification, basically. And they brought up AQR, Diversifying Strategies Fund. Now, I know who Cliff Asness is, and yeah, I when it comes to this kind of stuff, he's a genius or whatever. But they were bringing up like QDSIX And yeah, the expense ratios of this thing is kind of outrageous, but yeah, it does kind of zig when everything else zags. And I actually said, well, if I'm going to do this, I would rather take that 5% sleeve and put it in this QDSIX. But they are basically leaning into this, with Focus Partners Wealth. And like I said, they've done a lot of mergers, and Merriman was one of the mergers. And I just want to get your opinion on this. I know Don is going to topple out of his chair because the 2.95% fee on this thing is outrageous, or whatever it is. But anyways, I just want to hear what you have to say about that one.
Boy, it just ties right into what I was saying before about the fixed income portfolio. They are adding layer upon layer of complexity based on some, oh gosh, how am I going to phrase this? Oh, Tom and I were pitched these when we were Vestory. We were pitched the AQR and the Cliffwater stuff. And they showed us the data that shows that this does add some non-correlating assets, and we talked to Larry Swedrow about it, and he kind of agreed. But the reality is, Tom and I defaulted to simplicity. We generally default to simplicity because it seems like every other week there's somebody out there with a new idea. And I always refer back to a comment Eugene Fama made many, many years ago where he said, there's a new idea that comes, there's like 50 of these a year, these new investment ideas. And he goes, over my entire 50 years in this industry, I think there are only 5 that have ever really made sense. There's so many people playing in this alternative field right now because the fees are ridiculous. They're outrageous. The Cliffwater 1.8 expense ratio on one of theirs, the 2+, this is just abhorrent in my opinion. I mean, really, 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 really just ridiculously high fees. I got to tell you, and it's possible that Pella's going to offer these, and guess what I'm going to say? I wouldn't use them. That's what I'm going to say, because that's the thing. I am not going to sacrifice what I believe, what I think is best for you, because some wholesaler somewhere, some academic said that this is true. You better show me 50 years of evidence that holds up. And I got to tell you, these alternative investments don't have 50 years of history. They can't possibly, because they're based on consumer lending. There were no consumer lending products. And what in the heck is wrong with the Avantis REIT? What's going on is that people who have a lot of money, I truly believe this is what's going on. People who have a lot of money want their advisor to make them feel like they're getting cutting edge advice, that they're getting something really special and really they're on top of it. They're way ahead of just these indexers, these boring people like Don and Tom. We're way ahead of them. We've got the sophisticated stuff. Well, I don't buy it. Not until you have decades of honest to God experience with it. Sorry, I just don't buy it. Maybe it ends up working. Maybe it doesn't. But I know the fees drag you down. That I know. That is a fact. That I can count on. Fees are too high. I wouldn't touch them. There we go. Whew. I said it. Good thing I'm old. Although I'm confident that Appella would not censor me on this because they have said, say what you believe. And I admire a firm that says that. And I truly believe that Merriman is making, I don't know that they think they're doing what's best for the clients, but I just don't buy it. I mean, I wouldn't buy these alternatives. There we go. Let me get to my last question of the podcast. I've said my piece. I would skip them. I believe in simplicity, or a higher degree of simplicity. Thanks for your questions, and let's go to the last one.
Greetings, Mr. Spock and Mr. Mike, otherwise referred to as Tom and Don, respectively. I mention this for those who listen to the podcast and want to play the podcast drinking game. Every time Mr. Spock, Tom, says, fascinating, take a drink. Every time Mr. Mike, Don, goes on at length about his preoccupation with all things microphones, take a drink. Thank goodness for the Friday shows where I only have to drink half as much. Okay, now that was meant to be tongue-in-cheek and not a criticism, so this is my reason for calling. You've mentioned you're running short of questions for Friday shows, so I figured it might be a good time to ask this kind of question. At some point, you had a caller who said he was from Poland, asking the normal questions anyone from the U.S. would ask. But that did get me thinking and wondering about the investment advice you give, especially about being diversified both in U.S. stocks and bonds, but also stocks and bonds from outside the U.S. Does that advice work in the opposite direction? And should the percentages of both domestic and foreign investments of those living outside the U.S. be approximately the same, though, of course, domestic and foreign are also reversed? I'm not talking about a U.S. citizen living abroad, where the advice might more directly relate to U.S. taxes that person might be subject to regarding their investments. So if your podcast was broadcast out of England, Spain, Norway, or even Poland, would the advice given be significantly different? I look forward to your response. In the meantime, I have to head to the local ABC store to stock up for the coming Talking Real Money podcasts.
I'm sorry I'm going to disappoint you because I have to have disappointed you. I haven't talked about mics in ages. Mike, keep drinking. Mike. No, I haven't talked about mics because I got a new mic a while ago and I just love it. So I'm done. I'm mic'd out. I don't think I'm going to ever buy a new mic again. I truly done. So there, that defeats that. Now, fascinating, I don't know about fascinating. I didn't even pay that much attention. But the advice for a foreign investor, yeah, exactly the same. Exactly the same. If I was a Polish investor, 0.5% of my portfolio would be in Polish stocks, not 50. It's based on global market cap or some semblance of that. Mine is based on global market cap a while ago where, it was half U.S. and half international. The U.S. has exploded over the past few years, which I think has skewed things a great deal. So I'm still leaning half and half roughly. So if I was advising someone in England, I'd say half of your money in the U.S., half of your money in the rest of the world. I would say that because that's about what the percentages of the global economy are. In Spain, same. New Zealand, same. Australia, same. Wherever, same. Because you want to own the global economy in a relatively reasonable approximation of its total global value. So, yeah, always be the same. Same, boring, the same. And I'm done talking about mics. But thanks for the call. And thank you all for being a part of the program. And, Happy New Year. Or happy whenever it is that you're listening to this. And please keep listening. And if you have questions, send them in at talkingrealmoney.com. It's really easy. Go to talkingrealmoney.com and then click on the contact form. And if you want some advice free from an advisor, you just want to talk to an advisor and say, look at my crazy portfolio. What am I doing right? What am I doing wrong? Or am I on track for a retirement? We'll do that for free. That one meeting free. No sales pitch. You're not going to get pressured into doing anything. I promise, okay? Just go to talkingrealmoney.com, click on Meet an Advisor, and thanks for listening. We're here almost every day doing this really important thing. And what is that? It's Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Abundo Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Abundo Wealth, a fee-only registered investment advisor. Please see Abundo Wealth's ADV Part 2A on our website for information regarding Apello's fees and services. Apello Capital, LLC, DBA Abundo Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apello does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.